When banks fail, governments move in hours. When people fail, help moves slowly. Why do governments bail out banks but not people? At first glance, it feels unfair. If individuals lose jobs or homes, support is limited and delayed. If banks collapse, governments inject billions almost instantly. The reason is not kindness toward banks. It is fear of systemic collapse. Banks are not treated as normal companies. They are treated as infrastructure. 10 reasons governments bail out banks but not people. 1. Banks are the core of the payment system. Banks do not just hold money. They process salaries, business payments, loans, savings, credit cards, and international trade settlements. If major banks fail, the payment system freezes. Governments step in because if money cannot move, the economy stops within days. 2. Bank failures spread like dominoes. Banks are deeply interconnected through lending and derivatives. If one major institution collapses, others quickly face losses. This chain reaction can wipe out the financial system. Bailouts are designed to stop contagion before it spreads. 3. Depositor confidence must be protected. If people believe their deposits are unsafe, they rush to withdraw money. Bank runs destroy even healthy institutions. Governments act quickly to restore confidence and prevent panic withdrawals. 4. Banks control credit creation. Modern economies run on credit. Businesses depend on loans to operate and expand. If banks collapse, lending stops, and businesses fail rapidly. Governments bail out banks to keep credit flowing. 5. The cost of collapse is higher than the bailout. Letting major banks fail can trigger recession, unemployment, and market crashes. Governments often calculate that rescuing banks is cheaper than repairing a full economic breakdown. 6. Systemic importance over moral fairness. From a moral perspective, helping individuals seems fair. From a systemic perspective, saving the financial backbone prevents broader suffering. Policymakers prioritize system survival over individual justice. 7. Governments depend on banks to finance debt. Banks buy government bonds and help manage public debt. A banking collapse would make it harder for governments to finance themselves. Bailouts protect not just banks, but fiscal stability. Bailouts often protect depositors and markets, not executives. Although executives may appear protected, many bailouts focus on stabilizing balance sheets and preventing depositor losses. The public perception differs from the policy objective. 9. Political speed versus policy complexity. Stabilizing banks can be done quickly through liquidity support and guarantees. Helping individuals requires administrative systems, eligibility rules, and political agreement, which slows response time. 10. Fear of systemic risk overrides optics. Financial crises escalate rapidly. Governments move aggressively to prevent systemic failure, even